Have you ever scrolled past people saying, buy the dip, or I'm investing in Tesla, and thought, what are they actually buying? Today, we're breaking it down, what a stock really is, how it works, and why owning them could be one of the smartest moves for your future. A stock is simply a piece of ownership in a company. When you buy a stock, you become a part owner of that business, even if it's just a tiny fraction. Imagine your favorite company as a giant pizza. Each slice of that pizza is a share. When you buy a slice, you're saying, I'll take a piece of that success. If a startup has 1,000 shares and you own 10, that means you own 1% of the company. As the company grows, your slice becomes more valuable, and that's the power of investing. Stocks represent more than just money. They represent belief. When investors buy a company's stock, they're saying, I believe in what you're building. Every major company today, Apple, Amazon, Netflix, once started as a small slice of ownership sold to early believers. Those early investors weren't just chasing profits. They were backing a vision. It's also important to know that a single company can issue millions of shares. This makes ownership flexible, from massive institutions like pension funds to everyday people investing $5 at a time through an app. That's what makes the stock market powerful. It democratizes ownership. So why would a company sell pieces of itself? Because growth costs money, a lot of it. They might need cash to develop products, open new locations, or hire people. Instead of borrowing money they'd have to pay back, they sell small ownership shares to investors. That money becomes permanent fuel for the company to grow, and if it succeeds, both sides win. Meet Sofia. She's got a dream. A cozy little cafe called Bean Harbor. The problem? She needs $100,000 to open it, but she only has $50,000. So she comes up with a smart plan. She divides her business into 10 equal shares, worth $10,000 each. She keeps 5 shares for herself and sells the other 5 to early supporters. One of them, Marty, loves the idea. He invests $10,000 buying 1 share, and just like that, he owns 10% of Bean Harbor. Fast forward a few years. The cafe's booming. Sofia opens new locations, and the business that started at $100,000 is now worth $500,000. Marty's single $10,000 share? Now worth $50,000. A $40,000 gain just for believing early. But here's the flip side. If Bean Harbor had struggled, his investment could have dropped too. That's the deal when you invest. Bigger risk, bigger reward. And this is exactly how companies like Starbucks or McDonald's grew. They started as one store, raised money through ownership, scaled up, and eventually listed shares for the public. Every time you see a global brand, you're seeing a business that used stock to turn dreams into reality. There are 2 main ways to earn from stocks. Number 1, the price goes up and you sell for a profit. Number 2, the company pays out part of its profits as dividends, like a small thank you check for being an owner. Some investors focus purely on growth. They buy companies that reinvest profits instead of paying dividends. Others prefer steady income and pick companies that pay dividends regularly, like utilities or consumer staples. There's no right or wrong. It depends on your goals. Think of growth stocks as builders. They reinvest every dollar to expand. Dividend stocks are payers. They share profits with you regularly. A healthy portfolio usually has a mix of both. Stocks trade on marketplaces called stock exchanges, like the New York Stock Exchange or NASDAQ. But today, you don't need a Wall Street broker. You can invest straight from your phone using apps like Fidelity, Vanguard, or SoFi. When a company goes public, it lists its shares on one of these exchanges. So anyone, including you, can buy in. Before going public, a company goes through a process called an IPO, initial public offering. That's when they first sell shares to the public, and it's often the moment early investors finally get rewarded. After that, shares trade freely between investors, meaning when you buy, someone else is selling. That's what creates the constant movement in stock prices. There are 2 main kinds of stock, common and preferred. Common stock gives you voting rights and the chance for bigger profits, but also the biggest risk if things go wrong. Preferred stock is steadier. You usually don't get a vote, but you do get guaranteed dividend payments and a little extra protection if the company struggles. Think of it like this. Common stock is the roller coaster ride. Preferred stock is the smooth train. Most investors hold common stock because it offers higher upside potential, but some choose preferred for steady income. Large companies sometimes issue both types, giving investors flexibility depending on their goals. It's like choosing between a thrill ride and a calm, scenic route. Both get you to your destination, just in different ways. So why put your money in the market at all? Because over time, stocks have outperformed almost everything else. Savings accounts earn about 1 or 2% a year. Stocks have historically averaged 7 to 10. It's not a straight line. There are dips and corrections, but over decades, patience wins every time. Let's put that into perspective. If you invested $100 a month in the S&P 500 20 years ago, you'd have roughly $60,000 today, even after market ups and downs. That's the magic of compounding. Your money earns money, and that money earns more money. The key isn't timing the market, it's time in the market. Even legendary investors like Warren Buffett say the best holding period is forever. When you buy a stock, you're not just betting on numbers. You're buying into a real business with real products and real people behind it. Start with companies you understand and believe in. Spread your investments across several names, never just one. And remember, wealth builds quietly. The stock market rewards patience, discipline, and curiosity, not panic. Don't chase hype, focus on consistency. Every share you buy is a step toward ownership, freedom, and a future where your money works for you, even while you sleep. If this video helped you finally understand what stocks are, hit that like button, subscribe for more, and drop a comment telling me what topic you want me to break down next, Smart Money Hub style.